Hi, my name is Evan Ng, and I'm going to talk about how the Silicon Valley Bank collapsed. So a little bit of background. The Silicon Valley Bank began their operation in 1983. They specialize in providing services to technology and venture capital startup companies. In 2020, there was a growth in the technology sector, and their liquidity skyrocketed, which just caused a significant influx of deposits, and I'm going to talk about that later. And on March 10th, 2023, they collapsed after a bunch of customers withdrew a large amount of money. The California Department of Financial Protection and Innovation took possession of the company and appointed the Federal Deposit Insurance Corporation as a receiver. They conducted a material loss to review and determine why the failure resulted in a material loss. So the causes of the failure. The first was the concentrated business model. For the past 40 years, SVB have focused on the innovation economy, which led them to have a majority of their clients in the technology, life sciences, and venture capital sectors to maintain a dominant market position. They funded these private equity and venture capital, and it just makes them vulnerable to a large and sudden cash flow changes, as the deposits they make tend to be irregular and volatile, especially when faced with rising interest rates and any market challenges. Next is their concentration of uninsured deposits. So they receive a lot of deposits from their client base, and approximately 94% of those total deposits are uninsured, making the bank exposed to deposit outflows. This increases the risk of rapid withdrawals of funds, but management and the supervisors did not recognize this as a risk, and they believed that the clients would remain loyal given their strong relationship with the bank, which is not good. And lastly, the concentration in their investment portfolio. So during the period of low interest rates from 2018 to 2021, they invested a large portion of their clients' deposits in securities with long-term maturities. And about 65% of the hold-to-maturity securities had a maturity over 5 years long. Their considerable investment makes it risky, as the value of those securities decline in a rising interest rate environment, and they're not effectively managing their interest rate risk. Alright, so the ineffective board of directors oversight. Management was not able to effectively manage the bank's risk as it continuously grew. As the bank increased in size and complexity, management failed to implement effective risk management practices and controls, and the board of directors failed to hold the management accountable. The executives were not penalized for the poor risk, as the incentive program and the evaluation did not take those things into account. The board of directors also lacked experience, which just impaired their ability to oversee any of their banks. Alright, next is ineffective risk management. When interest rates rose in 2022 from 0.25% into 1.75%, and the funding from the venture capital activities declined, they did not recognize the market change until it was too late, and by then the clients withdrew cash to fund their operations, which just led them to collapse. They projected the rates would remove its interest rate hedges, which was a significant error in judgment considering the rising rates. As the rates continued to rise, they had an increase in unrealized losses on their securities. Their hold-to-maturity securities losses grew from 1.3 billion to 15.2 billion, and their other securities losses grew from 313 million to 2.5 billion by the end of 2022. In conclusion, even though they collapsed when their clients withdrew large amounts of cash to fund their operations, their failure comes way before that. They were too focused on their volatile client base, their concentration on their investment, and had a weak corporate governance and risk management. And that's the end of the presentation. If you have any questions, please feel free to email me. And this is the list of the sites I use.